pump pain. The national average for a gallon of gasoline topping $2.66 a gallon, nearly 30 cents higher the same time last year. And it could get much worse. A new report in the Wall Street Journal says production cuts from major exporters could send prices to the highest levels that we've seen in years this summer. Joining us now, publisher of the Schork report, Stephen Schork. Stephen, what's going on? How high will prices get this summer?
Well, Dagan, I first really have to point out that this is a good thing. After all, economic growth drives commodity prices, not the other way around. So when prices crashed 3 years ago, there was this misnomer out there that this somehow is a good thing because it gives consumers a tax break. No, the economy is stronger, growth is stronger, and hence demand is stronger, and then prices will follow. But let's keep in mind that over the last 3 years, crude oil prices were artificially low for two main drivers. First and foremost, in 14 and 15, Saudi Arabia refused to pull back production, and U.S. debt-laden producers in the shale patch had to continue producing. Over the last 2 years, the market has retrenched. Prices have stabilized in that $55 to $65 range. I don't see them going much higher. Hard to see them going much lower. So we're starting to see some normalcy into the market, and prices are now retrenching back into a very normalized range. Dagan, I also need to point out that at $2.70, gasoline prices today are still 20% cheaper than they were in the early 1980s. So consumers have to take into effect what good or service out there has watched its demand increase, its ability to source and produce decrease, and yet is still 20% cheaper today than a generation ago.
Brian, with all due respect, and Lee Carter was making a face, when you pull up to fill up. I did it because I drove 20 hours in the last several days. And when I was pulling up, and when I'm filling up that rental car with premium, and you're paying well north of $3 a gallon, like people get angry. I don't care if it's because the economy's doing
in the hot summer weather, that's what makes you really angry when those prices go up. But Stephen, to your point about the shale patch, I mean, there is so much supply ready to come online as these prices rise. I mean, really, isn't there a boundary on the upper end for these prices that we just shouldn't be worrying about too much, given the supply across the world and especially in the United States?
Right, exactly. Especially here in the United States, what we're already starting to see is a significant rebound in crude oil stocks. That is to say, Permian, the most prolific crude oil field in the lower 48. The pipelines shipping crude oil either up to the NYMEX hub in Oklahoma or to the refinery market down in Houston are telling us that these lines are chock-a-block. So there is still a lot of supply, and production to this point will continue to rise. There is a lockstep correlation between crude oil rigs, the more rigs, the more production we are getting, and the 4-month lag in WTI prices. So that said, we can continue to see rig counts will continue to rise, production will continue to rise, and yes, I do believe there is a ceiling to the market, $65 to $70. So at $2.70, what we know from history in the inelasticity of demand for prices, consumers are willing to pay up to $3.30, $3.40. Now, we're going to get nowhere near there, so demand will remain robust, but certainly there is a limit because producers will match this demand.
Stephen, it's Mike Murphy. Just so now we see gas prices going up at the pump, we see oil prices going up. When do the U.S. equities, energy equities, start to follow suit and really start to get out of this underperformance that they've had for several years now?
Right, Mike. And the clients I speak to, and we have a number of clients in the daily report that are on the production side, that $50 level, it's a psychological level, but that is the level that they were gunning for. So now that prices have hovered in the low 60s to actually high 50s to the mid 60s for most of this year, I would imagine, Mike, over the next couple of quarters, because demand is very strong right now. In fact, refinery demand has never been stronger at this point of the year. So demand is strong. They're producing more. The margins are there. So, Mike, I would imagine in the next 2 quarters, you'll start to see the spillover to these higher prices.
The Saudi Crown Prince, Stephen, wrapped up his 3-week U.S. tour in Houston over the weekend. The heir to the throne met with former presidents George H.W. and George W. Bush. He was in the region to visit as Saudi Aramco Research Center. This comes as the company pushes toward the largest IPO ever, likely next year. Your thoughts?
Right. With that IPO, there were a number of options. I think they're pulling back because, I don't know, maybe 3 years ago they thought the dip from $100 a barrel down to $25, we were going to back to $100, and hence they were pretty cheerful about this IPO. We're not going back to $100. We're pretty much at the limit right now, so I think that's going to change. I think what's really interesting about the Saudi visit here, and of course all of the moves being taken by the new Crown Prince, is the fact that we're starting to see what we in the Schork report identified 3 years ago, was that Saudi Arabia, thanks to now a surging Iran, which is now flexing its soon-to-be nuclear muscles in the region, you're forcing now Saudi Arabia and the Sunnis to forge a greater alliance with the West, and that includes Israel. So it's a very interesting paradigm that we're now shifting into, and it's also a major black swan, a potential event over the next few years.
Stephen, and we are lucky to have you here to walk us through it and to look into the future.
I appreciate
for us.
that. Thank you.
Thank you, Stephen Schork.